Retail traders often struggle to catch market bottoms because they view them as single events, a specific candle or a pivot point that signals the end of a drop. But look at the market through the lens of depth. Underneath those 2D candlesticks lies a complex landscape of resting orders. A true market bottom is a multi-stage, engineered liquidity extraction process. Understanding this requires acknowledging the physical constraints of large institutions. For a multi-billion-dollar fund, the primary obstacle isn't being wrong, it's market impact. When a massive order hits a thin order book, it consumes every available limit order in its path. This forces the fund to buy at increasingly higher prices, moving the market aggressively against their own entry. To avoid this, institutions must find pockets of extreme counterparty liquidity. They break their large parent orders into smaller child orders and execute them where they can be absorbed by a high volume of incoming sell orders. This necessary density of selling is most reliably found during retail panic. Mass liquidations provide the volume required to fill institutional size without causing slippage. By analyzing volume and order flow, we can track the 5-stage mechanical sequence used to absorb this panic and reverse the market. While price patterns alone are often noise, tracking the mechanical footprint of liquidity absorption makes these institutional reversals identifiable. Step 1 is a violent downtrend. High-velocity selling and wide-range candles signal mass retail panic. Analyzing this requires one mental model: effort versus result. Effort is measured by total volume, the energy entering the market. Result is the actual distance the price travels. In a trending market, high volume typically results in a significant price extension. Effort and result move in tandem. Step 2, absorption. Massive volume bars appear, but price candles cluster and narrow. Extreme effort, negligible result. Price has hit a wall of passive limit buy orders. Institutions sit here, allowing panic selling to crash into their position without breaking lower. The institution uses the retail panic as cover, accumulating their position quietly while high-volume selling prevents price from rising. High-volume selling that fails to drive price lower confirms that every market sell order is meeting a passive limit buy of equal size, marking the start of institutional accumulation. Once the initial wave of sellers is spent, the market drifts into a weak, low-conviction bounce. Step 3 is the retest. Price naturally returns to the level of initial absorption to probe for any remaining supply. This retest must be validated by volume. We need to see a sharp contrast between the massive volume spike of the initial crash and the contracted, anemic volume of the retest. Low volume on the retest proves that the aggressive sellers have left the market, and supply is currently exhausted. Step 4 is the trap. By holding this level twice, the market creates a visual support floor that retail traders use to anchor their long positions. This behavior concentrates liquidity. Retail traders place stop-loss orders directly beneath this support floor. A stop-loss is a mechanical trigger. The moment the price touches it, the order is instantly converted into a forced market sell order. Institutions wait for price to breach this floor, triggering a cascade of stops. This creates a sudden burst of forced selling to finish their position. Because the selling is mechanical and not driven by conviction, it is short-lived. The institution absorbs this final spike, often at a significant discount, causing the price to snap back into the previous range almost immediately. The breach of a support level right before a reversal generates the massive sell-side liquidity required to fuel the institutional move higher. Step 5 is displacement. Following the trap, the market produces an aggressive, impulsive move in the opposite direction. This velocity indicates a dramatic shift in the order book. By clearing the stop-loss clusters below, the market has exhausted the immediate pool of sellers, leaving little resistance to the upward repricing. For confirmation, this move must create a market structure shift. Price definitively breaks the last meaningful lower high from the inside. This speed leaves behind a fair value gap, a zone where price moved so fast it skipped levels, leaving the order book thin. This imbalance signals institutional urgency. It is the footprint of a regime change in the market's order flow. Displacement is the final confirmation that the trap successfully absorbed all opposing flow. At this stage, the path of least resistance has decisively shifted upward. Validating a bottom requires this complete chain of evidence: exhaustion, a retest, a liquidity sweep, and displacement. While many traders chase the impulsive displacement candle, a disciplined approach requires waiting for the market to normalize. The execution protocol is to wait for a pullback into the displacement's origin, specifically the order block or the fair value gap created during the breakout. Price often returns to these levels as market impact fades, and the institution's residual limit orders act as a draw for the price. This model also provides a clear invalidation point. If the price breaks the support floor during the trap phase and fails to reclaim it quickly, the bullish thesis is void. A failed reclaim indicates that the stop-loss cascade has become self-reinforcing, signaling trend continuation rather than a bottom. Success in trading reversals is found by waiting for the mechanical chain of evidence to prove that institutional accumulation is complete.